Ronit and Aurav invest in stock market, but Ronit earns more than Aurav. Can you guess how? Well, he does it through tax harvesting. So now we will tell you what is this tax harvesting. You can increase your returns on your investments made in the stock market through tax planning. This is technically called tax harvesting. You have to pay long-term capital gain tax on the return you get by investing in the stock market. But tax harvesting can help you reduce this huge tax outgo. Before we tell you about tax harvesting, you must know what is long-term capital gain tax. Mathematics of long-term capital gain tax. If you make profit on selling of a share or a mutual fund unit after holding for more than 1 year, then that profit is technically called long-term capital gain or LTCG. The tax which the government authorities levy on the LTCG is known as long-term capital gain tax. You don't have to pay any long-term capital gain tax on the profit made of up to rupees 1 lakh in a single financial year. Long-term capital gain tax of 10% is levied only on profits made over and above the rupees 1 lakh. But through tax harvesting, you can reduce this tax outgo. Now let's understand what is tax harvesting. For tax harvesting, you will not hold shares in the long term, but you will have to sell the shares after holding for a definite period, and then again you will have to buy the shares at a higher price. This way, you can reduce the tax outgo on your investments. Let's understand this by an example. Suppose on March 24, 2020, you buy 328 shares of a company X with rupees 1 lakh capital at rupees 305 per share. In the next 1 year, the share price of that company X increases to rupees 610. Now on March 24, 2021, you sell all the shares of the company X at rupees 610 per share, thus making a profit of rupees 1 lakh 80. You won't be taxed on the profit of rupees 1 lakh, but you will have to pay the LTCG tax of 10% on the remaining profit of rupees 80 that you have made. So at 10%, you will pay capital gain tax of rupees 8 for the entire financial year. Now on March 24, 2021, you again buy shares of the same company at the price of rupees 610 per share with rupees 2 lakh 80 capital. Now you sell all the shares of the company after 1 year from here, that is on March 25, 2022 for rupees 3 lakh 120 at rupees 910 per share, thus making profit of rupees 1 lakh 40. Again, you will not have to pay any tax on your profit of rupees 1 lakh made, but you will have to pay tax on the remaining profit made of rupees 40, which will come to rupees 4. Now let's see how you have saved money in this example by selling the shares after every 1 year instead of selling it straight after 2 years. You paid total tax of rupees 12 by selling at intervals of 1 year. But you would have paid a tax of rupees 10,012 had you sold the shares straight after holding for 2 years. In this 2-year period, you would have made total profit of rupees 2 lakh 120. So now you have saved rupees 10,000 through tax harvesting. Tax expert Balwan Jain says you can save tax in the long term by buying shares immediately in the same year in which you had sold the shares. This is called tax harvesting. You can even apply this method on mutual funds by buying mutual fund units on the same day on which you had sold. We follow this in our profession and save lot of tax over the course of say 10 years. Money9 suggests you can reduce your tax outgo on your investments made in the long term through tax harvesting. The government has kept this window open so you are free to utilize it. You can reinvest the money saved through tax harvesting in equities to make further gains. Let's understand the hacks of tax harvesting on Formula Guru.